Welcome to XM.com for this Forex Preview video. The next big test for the US dollar undoubtedly would be the CPI report, which is out on Tuesday, with expectations pointing to another moderation in inflation. I'm Cristina Marujos. With me today is our senior investment analyst, Geralambos Pisuros. Geralambos, what could a further cooling in inflation mean for Fed rate hike expectations moving forward?
Hello, Cristina. Before we examine how the data can affect Fed rate hike expectations, I think we need to explain where expectations are currently standing and how we got here. Last Friday, the US employment report showed that non-farm payrolls surged by 517,000 in January, with the unemployment rate hitting a more than a 53.5-year low of 3.4%. And soon thereafter, the ISM non-manufacturing PMI rebounded strongly back into expansionary territory, adding to hopes that the US economy may eventually avert a recession. The result was a massive wave of dollar buying and a strong rebound in treasury yields as investors revised up the level of where they expect interest rates to peak and priced out one of the 2 quarter-point rate reductions they were seeing towards the end of the year. Now, although Fed Chair Powell reiterated his disinflation remarks on Wednesday, market pricing was not altered much. Currently, investors are pricing in a terminal rate of 5.18%, more or less in line with the Fed's own projections, while they see interest rates being around 25 basis points lower by the end of the year. Now, with regards to the CPIs, this data set has proven to be the dollar's biggest nightmare in the past, as consistent downside surprises in previous months were the fuel behind speculation for a Fed pivot and 2 quarter-point cuts until December. Both the headline and core rates are expected to have continued to decline to 6.2 and 5.5% year over year from 6.5 and 5.7% respectively. Nonetheless, with the year over year change of oil prices dipping further in the negative territory, the risks surrounding the headline rate may be tilted to the downside. So another downside surprise could revive speculation about a lower peak in US interest rates, as well as more rate cuts for later this year.
Now let's turn to the market reaction. We saw the dollar staging a comeback on the strong NFP and ISM reports, as you mentioned previously, Geralambos. So how could it perform on the inflation data this week?
Now, if a potential downside surprise in the CPIs convince investors to bring back bets with regards to nearly 50 basis points worth of rate cuts by the end of the year, US Treasury yields may come under renewed pressure, and thereby the dollar could be sold again. Now, with ECB still expected to continue raising interest rates more aggressively than the Fed, especially following hawkish remarks by German policymakers Nagel and Schnabel, Eurodollar may rebound and continue its prevailing uptrend. Now, from a technical standpoint, Eurodollar is now testing the 10670 zone, which coincides with the 50-day exponential moving average. In the bigger picture, despite the steep slide following the NFPs, the pair is still trading well above an uptrend line drawn from the low of September 28, which keeps the door for a rebound in the foreseeable future wide open. Should the price rebound back above 108 after the CPI data, traders may be encouraged to put the key resistance of 111.75 back on their radar. Now, in the case of the US data surprising to the upside, the pair could fall below 106.70, something that could allow declines towards 104.75. Nonetheless, even in the case of such a slide, the pair would still be trading above the aforementioned uptrend line. In my opinion, for the outlook to turn overly bearish, a clear dip below 102.15 may be needed.
Geralambos, thanks so much. This was a Forex Preview. Thank you for watching at XM.com.